Now let's take a closer look at all the market movements this past week. U.S. stocks rebounded on the last trading day of the week. Wall Street was buoyed by cooler than expected inflation data. The Dow Jones Industrial Average surged over 1% after a brutal 1,100-point drop earlier in the week. The S&P 500 rose 1.09%, while the Nasdaq Composite advanced 1.03%. European markets ended the week on a sour note, with the Pan-European Stock 600 index declining 0.78%. Almost all major indexes in Europe saw losses, reflecting investor concerns about economic growth and geopolitical tensions. The European Union faced fresh uncertainty as U.S. President-elect Donald Trump suggested new tariffs on the bloc unless it increased oil and gas imports from the U.S. Meanwhile, global demand concerns and weak inflation data weighed on sentiment. European stocks face further challenges as investors await the impact of tightening monetary policies and potential political instability in key regions. Asian markets mostly retreated on Friday, with Japan's Nikkei 225 falling 0.29%, while South Korea's Kospi dropped 1.3%. The region's performance was shaped by a combination of weaker than expected inflation data in Japan and cautious sentiment ahead of China's interest rate decisions. The People's Bank of China kept its key loan prime rates unchanged, which did little to reassure investors who are worried about the slowing economy. Crude oil prices saw minimal movement on Friday as traders weighed the impact of global demand concerns and the cooling U.S. inflation data. Brent crude rose by 6% to $72.94 per barrel, while West Texas Intermediate gained 8 cents to close at $69.46. Both benchmarks ended the week down about 2.5%. Gold extended its gains on Friday, supported by a weaker U.S. dollar and a decline in Treasury yields following the release of cooling U.S. inflation data. Spot gold rose 1.1% to $2,623 per ounce, while U.S. gold futures increased by 1.4% to $2,643. The soft inflation print and weaker dollar made gold more attractive to overseas buyers, strengthening its appeal as a safe haven asset. Bitcoin hovered around the $97,000 mark, recovering from earlier losses. The digital asset dipped below $93,000 before bouncing back, continuing its volatile movements. Bitcoin's price has more than doubled this year, driven by favorable growth like the launch of spot exchange traded funds and the election win of U.S. President-elect Donald Trump, who has supported pro-crypto policies. Well, looking ahead, the markets will focus on key economic indicators, which includes U.S. GDP growth and consumer confidence data to gauge the health of the economy in Europe. The ongoing uncertainty and trade with the U.S. will also be crucial for sentiment. And well, for more on this, we are now being joined by Andrew Holland. He is the CEO of Avendus Capital Public Markets Alternate Strategies LLP. He's joining us from Mumbai, India today. Welcome to the broadcast, sir. First up, what are the main reasons for the fluctuations in the previous week?
So I think a number of factors. I think the biggest factor for last week was obviously the Federal Reserve, and whilst they kind of cut interest rates by quarter of a percentage point, which is well expected, it was a hawkish commentary that came out, from the Federal Reserve Chairman Powell, really saying that they're going to go back to targeting inflation, which was, I think, a surprise for the market. I think the underlying message is that whilst those figures on Friday were not so bad in terms of inflation, I think it's priming us for less rate cuts because he feels that President-elect Trump and some of his policies might be inflationary initially. So I think that was the kind of hidden message, is that don't expect interest rates to fall down so quickly now because there could be some changes in how the economy faces up to some of Donald Trump's policies and maybe potential tariffs. So I think that was the message, and the market didn't like it.
Right, Mr. Holland, Indian stocks are down almost 10% from their recent highs. Should investors expect more pain ahead?
I think investors should expect more volatility because, now it's towards the back end of the year. So maybe, foreign investors will be less active. But, going into January, there's so many moving parts. We got the earnings results here in India starting, and I expect those to be followed by more downgrades. Then, of course, we've got President-elect Trump on the 20th, taking over the administration. So I think, for investors, I think just sitting on the sidelines for the next 1 month is probably not a bad strategy. Hold some cash and just wait to see what some of these policies might be and how it affects emerging markets. Because whatever we're seeing at the moment, it's meaning that the dollar's strong, which is never good for emerging markets of metals. So that's the kind of backdrop you have. I think the only one key positive I can think of at the moment for India is maybe some kind of optimism towards the budget in early February. But I think January could be a very volatile month.
Just to follow up on that, do you see emerging markets like India sliding further now that the Fed foresees just 2 rate cuts in 2025? Right, Mr. Holland, if you can hear me, just to follow.
Yes, sorry.
Right, just to follow up on that question. Do you see emerging markets like India sliding further now that the Fed foresees just 2 rate cuts in 2025?
I mean, the 2 rate cuts in 2025 is a disappointment. And already, there's some commentary out there saying that potentially there might not be any rate cuts. So where does that leave the Reserve Bank of India, when they come to meet in February? I think probably 25 basis points could be on the table. But what I do feel is that, for India, we're facing this slowdown in GDP growth, and we're not seeing the government pick up spending, and neither the private capex. Interestingly, there's I think a Siemens analyst meeting on Friday, of which the company mentioned that they're seeing a slowdown, which is why you saw all the capital goods stocks fall quite sharply on Friday. So, I think the earnings downgrades will probably mean that the market, if we're going to be in a range, it's on Nifty, it's going to be around that 23,000 to 25,000. There's no particular catalyst now for the markets to move significantly higher, particularly in the next few months. So I think it's going to be a tricky time, and it's going to be a volatile time. So I think, pick out your sectors that you like for the long term, and those are the ones you keep investing in.
My last question to Mr. Holland, what is your bull case and bear case target for the Nifty for 2025?
My bull case would be, I'm thinking that earnings might grow by 10%. So if that was the case, then a 10% upside from here in terms of the Nifty index. But I think I might be optimistic. So I think it's best if we could hold around these levels for most of 2025. I don't think that would be a bad outcome for the markets.
Thank you, Mr. Holland, for joining us on World Business Watch with your insights.
Thank you.